strategist. Henry Howard is here, head of client services. So we're all three on hand. So appreciate that. Okay, recording has started, and it's December 5th. I had to look to remind myself. December 5th, 2024, coming into the gun lap of the year. And I'm Tim Quast with Market Structure Edge. This is the weekly demo and discussion. Again, two quick things. Just mute yourself if you would during the discussion, and please ask questions. Our aim is to help you to the very best of our ability to use the platform. And it's not perfect. I got stopped out of GameStop, which I knew would deliver the goods today. And if that's the problem with putting in a stop and a limit, I was only willing to take about a 2.5% risk on a stock with 7% volatility. So you always have to think about that. How much risk would I tolerate for a stock that has, I think that's what it is, 7% volatility? Well, now it's up. Well, it was up 10%. So, good. I'm glad you did it, Forrest. I bought it right at the close, like at 3:57 p.m. Eastern time yesterday, and I thought, well, that's a pretty good opportunity, I would say, but I got stopped out. I'm glad you didn't. We'll come to that. I'm going to kick us off, and then Brian Wilson is going to take a chunk of this too. Let's try our best, Brian, to see if we can keep it a little shorter. The last demo, I think, was 45 minutes, and we don't mean to keep you that long. Mm-hmm. So what I want to talk about, I said, I try to go back and look at the notes and say, what did I say I would talk about in these, in the next demo and discussion, and do that to the best of my ability. And one of the things I mentioned, here, I'll share my screen. Oh, no, that's not right. Hang on. Was making sure, and most of you who are longtime users, you're pretty comfortable with this, but I like to focus on what to think about with the daily data so that you could do this very quickly. Our aim is to minimize the amount of time that it requires to be a proficient and successful investor, trader, because we tend to trade shorter term. But look, you can use these data really well for longer term management of equity positions. I met with my financial advisors who run our managed accounts. When was that? That was this week, and I always share. I say here's how I look at if we have capital to deploy. Do we want to do it here or look? I prefer to deploy capital if I'm going to dollar cost average in. I don't want a dollar cost average in when broad sentiment is 6.6. Why would I do that? When I know statistically there's a very high probability that the market declines. Could I get a better entry point? Not every time, but it's a lot better to deploy that capital when the market is rising. And the same principle applies. If you want to remove some capital or you need a distribution from a fund, well, look at broad sentiment. It can help you. You can say, well, if it's in a particular area, you can use broad sentiment to help you do that. But it becomes a very useful, not perfect tool for knowing how to do those longer range things. There's no question we've had a disconnect in here. This to me is something that is going to manifest at some point. Doesn't always, but what I'm talking about is, you see, this is the view of demand, supply, and price. And price is a consequence most of the time of demand and supply. It's not always, but as a general rule, it's a very good indicator. You go back ahead of the election, the broad sentiment had come down and bottomed, and supply was declining, and it's already really at low levels down here at 46%, when a lot of the time it's around 50% of the market. Doesn't mean that the market's going to pop, but it gave us a pretty good idea that the market would do well. The disconnect here, where during options expirations, we had the dip, demand went over the red line, steep drop. I shorted that. Very good trade. And here, this is interesting. Then we peaked and declined, and the market didn't follow. That is not common. And it demonstrates the disruptive size of the outcome of the election. And you don't know. People use leverage. We can only get an implication of that in the risk management behavior. And every now and then this happens. You could say on the supply remained very low, just kind of plateaued there and then continued to decline. But it happens every now and then. But as a general rule, it gives you a really good tool for knowing how to modulate the data. And those are the things I look at. I mean, literally in 2 minutes, you can go, I log into the platform, I check the number in momentum and low volatility. I like to look at my mega caps portfolio, but it's really similar to big tech, right? These two are going to be, as tech drives a lot of it. And I want to see what the supply-demand relationship is, 30-day supply and demand. Is demand rising, supply? Ooh, we have a turn coming there. I look at those things. Then I look at broad sentiment. And all of that I can do in less than a minute. I can do boom, boom, boom. And I know kind of what the conditions are. One of the things that I have done, and at this point, it's not a good trade. It's not a good, and it may or may not work out. I like to trade volatility based on supply demand trends in the market. When we go over the red line, oftentimes it's a good place to make a volatility bet. It works a lot better when supply is rising than when supply continues to fall. So my volatility trade at this moment isn't working, but I'm willing to take a certain, it always comes back to what amount of risk would you take? And I come back to the 1, 2, 3 rule. The SPY tends to move about 1%. It's below that right now. The whole market, the S&P 500 components move about 2% on average. They're right about at that level. And then momentum moves 3%. Well, it can be 10% like GME, but you're after a portion of that mathematically you have a high probability of achieving. So I certainly think about those things from a risk standpoint. So with volatility in the market ebbing very low, you look at supply demand in SPY, demand's very steady. Supply weirdly peaked in here, and then is really low. It's very low everywhere. So I have made a volatility bet because broad sentiment at 6.6 is top. Statistically, there is a probability of a 5% decline. That's just looking at the historical data set. You look over the entire data set, something that we do, and what has happened when the market is at that level, it's declined 5% in toto. It just tells you what happens during it. Doesn't mean it's going to happen. I've realized that you could make a very bullish argument for the market all the way through year end. I get that. There's nothing in the data that necessarily tells me otherwise, except that there's broad sentiment that's peaked, volatility is very low, and supply is very low. So then I think, well, what is likely to follow those things? Higher short volume, declining demand, and volatility. What always follows periods of low volatility? More volatility. Again, I'm not saying that's going to happen. But it's the reason why I thought, well, I'm gonna take a flyer on that. That's not something I do very often. Again, it's kind of interesting. Could be costly. The problem with the volatility bet is if volatility continues to erode, it costs you money, and it can cost you significantly. So you have to be, very careful about those things.
Hey Tim, two quick questions for you, especially for our new users. Can you maybe talk through how you play a volatility trade, how you might do that?
Yeah. So I routinely will use UVXY, which I got from Brian Wilson, got from you, Brian, because you can make money both directions, right? So what I like to do is you look at broad sentiment, you have supply and demand, and you can bet directionally. You could use leverage or not. I tend to. Might be if it's S&P 500, I'll be, SPXU, SPXL. They're leveraged ETFs. Am I a fan of ETFs? Not necessarily, but they're good. They work for. I don't like that the market is full of speculative instruments when it's supposed to be a capital formation tool for public companies. Having said that, these are excellent, highly liquid, very useful instruments. So if demand's peaked, and supply starts to rise, now I probably make a modest short bet, but I hedge it with a lesser long bet, long play, um, and then buy UVXY, which is a volatility trade. It's a leveraged volatility trade. That means if there is up or down movement of significance, I can make money. And I protect myself with the underlying long or short plays. It's a very good, very effective way to do it. Those trades don't last very long. They're designed to be one-day trades. You have to realize that they deteriorate over time because they're backed by derivatives. They're a derivative of by themselves, backed by derivatives. Right? So is that good? No, it's not good. But we are traders, and if we understand what we're doing, if you understand market structure, supply and demand, what the money is doing and how the market works, you can use these things to good effect. And so, here, I'll let that individual in. That's what I tend to do. And I can, so if that answers, is there another question?
I had one other question. We might have a couple in the chat room. You mentioned the 5% drop from these levels. Can you describe what that means?
So what that means is when we total the data set. So 2017, when we had this, what I would call apples to apples data set, where we're consuming data from stock exchanges that is the same, meaning that what we measured then and what we measure today, other than the changing construction and the continuing shift to passive, is the same data set. Over that period of time, we can measure, well, what does the market do at each, increment of demand? So, between 5 and 6, what does it do? Well, a substantial percentage of the gains, most of the gains occur in that range. So then we can calculate, well, if we add up the amount of time that the market spends above 6.0 or 6.5 or whatever, 6.6, and we add up the entire data set, what is the cumulative total of returns at that point in that range? Well, it's negative 5%. That's how we get to it, give or take. Doesn't mean the market doesn't have, you could add up, you take a data set and you have declines, up 3%, down 8%, up 2%, down 2%, and so on. When you put it all together, you get an average. That's what we're doing. So it's not a perfect read, but I know what the central tendency, the probability is in these ranges.
And that's kind of like sentiment 6.5, north of 6.5, thereabouts?
Yep, 6.5. Okay. We look above the red line, the probability of continuing returns deteriorates. Yesterday was a good day. We were above 6. It's not perfect. It can be one side or the other. You just know what the central tendency is. So, you have to beware that it's not a perfect read, but I know what the probability is. And you might say, well, what about context, options expirations? There are no options expirations until the week after next. I think that's right. Isn't that right? I believe so. Might be the end. Yep. Okay. So you say, well, there's no event that would cause it. Well, there's jobs data tomorrow. I don't know what's going to happen. The world is, the world's crazy. You got the French government collapsed. You've got the imposition of martial law and its immediate removal in South Korea. You got a civil war in Syria. You've got stuff going on all over the world, and the market doesn't even pay attention, right? Because it's run by machines. It's not rational. It very much reflects the fact that it's algorithmic and quantitative. And but you never know, right? You just never know. You could take GameStop, which, here's where I get the 7% move. I could look at this and say, well, if you could buy it, I bought it at, I think, $26.99, and I got stopped out because I set a 2.5% limit down. It's all I was willing to do because I couldn't pay attention. But I could look at it and I set my limit around this level. Well, it went to 30. Right? How do we know that it's going to do that? We don't, but we know there's a demand supply imbalance and that it moves 7% on average. Happened to move more than that today. But that's my point, that there can be outliers. That read is a probability only. But we knew that there was a very high 93% probability that you could make 2% on that in 1 to 5 days based on the map. So those are all things I'm going to look at. I'll very quickly take those 1 minute or so to look at the big picture and know what the money is doing and how the market is positioned. I know the options calendar. Come look at this. I like to trade the momentum portfolio more. Low volatility works fine, but it's lower risk, less chance of being stopped out, lower return. And so in a very short period of time, I can commit some capital with reasonable risk taking and a high probability in just a few minutes. And that's my aim every day. Okay, other than talking about
Tim, one question from Joe. Do you normally buy UVXY at the end of the day, like your stocks, or at the open or in the pre-market?
Joe, nice to see you. I prefer, this is not an absolute, but I prefer, and I realize there is an associated risk, to buy at the end of a day and then hopefully have an opportunity to exit near the beginning of the next day. Doesn't always work out. Now, why would I do that? You say, well, you're holding it overnight. I mean, the world could blow up overnight and then you get killed. Well, you can trade outside market hours with Interactive Brokers if you need to. The probabilities, again, that's all we're talking about. There are always the risks, but that is a very high probability trade because for Citadel starts over. Citadel ends the day at 0, roughly. I'm using Citadel as an example. It's the biggest market maker in the market. Their principal job is to sit in there and take a tenth of a penny or a half penny from everybody by reacting to how prices. They're supply demand traders. That's what they are. End of the day, they finish at 0. They start the next day and they trade things. Well, we already know what the supply and demand balance is, and they're not tracking that per se. Very sophisticated. They're not concerned about that because their model is different. Their model is, what do we do with an investment horizon of a day or less? So if I have an investment horizon of a day or more, at least I have that step on them. Doesn't always work out. There are times when I buy near the open, and I know that we run through a cycle. It tends to be, could be 9:30, could be 11, then the stocks move. Why does that happen? Because machines are doing that. Machines are sifting through all of the hidden orders, trying to trip them, trying to figure out where the supply-demand balance is. They're hunters. That's what they are. And so we have to be aware of that. But my preference, end of day, exit the next day. Now, there are times I hold things 2, 3, 4 days. I might. If the stuff isn't moving, and I know that there's, the stock can sit there for quite a while, not moving, but you go, yeah, but I know the volatility is 4.6%. So what's the probability in 5 days? In that period of time, there will be a manifestation of that volatility. What's a 5-day read? It's a 5-day average. So if it moves 1%, 1%, 1%, 1%, boom, you have to be willing to wait for that period of time. After 5 days, there's a significant deterioration in the probability of that return if you're trading short term. So that's how I think about it. And 90% of the time, I'm 1 day to 2, so it's 2 days. Parts of 2 different days. That's my horizon. Okay, that's what I've got. I'm going to stop sharing, and I can answer questions, but I'll let you. I'll let you take shall I pass the baton? I'll pass it to you, Brian Wilson, and Henry, you can certainly weigh in.
Hey, Tim, I have one question for you before you go.
Yeah, Barry.
Hey, I've just been noticing that on, if you go to broad market sentiment, I know you guys have a 5-day moving average on the demand. And it just seems like if you skew that several days back from the actual market data of the S&P, it seems like it really matches up pretty well with where the market's going. So if you look at like say on the 27th there, if you were to skew that back, I don't know, 5 to 8 days, something like that, it starts really. And if you move that the whole chart to the left a little bit and take some of that moving average out, it seems like it lines up a little bit better with the actual S&P. And I don't know if you guys have seen that or not, but I'm just seeing that. If you see where
like stagger them, is that what you're saying, Barry?
Well, like say you took the 1127 and skewed it to the left and
I'm
left
27.
S&P alone, and matched it up with that valley there, yeah,
Yep.
right to the left there, and the same thing if you skewed it the whole way over, it seems like the upturn in the market lines up better with that um, data. I don't know if just visually look at that and skew the actual demand to the left, like 5 to 10 days or whatever. Seems like
Yep.
it seems to match up better. I know you have a built-in 5-day skew because of the moving average, right? In
Yep.
that data. So, have you ever looked at making it more real time rather than having a moving average just for the smoothing?
Yes, we have. And we do run it we do run a daily internal read that is not smoothed. Now, if you take any comparable period of time, there is no difference in the average. So for instance, if I took the daily volatile read and so for short periods of time that can be true, but it's worth a look. I get your point. If you're taking if you moved this 5 days back, it would perfectly match the jump, and then
Yeah.
the bottom would track what the market has done.
And look at the ones even out towards 9.4. If you skew them a little bit, it seems like it matches up better too. I think maybe it's not perfect, but you see where I'm going with that.
I do.
It'd be interesting to have your mathematician, look at that, or whoever would look at that and say, hey, maybe our doing it more real time for that calculation would give us some information we don't have right now.
We can do it. We'll do a quick look at. I mean, we do look at that, and we've looked at it a lot. But it doesn't mean it doesn't deserve another look. And I agree with you. And we also, internally, and I've thought about supplying it, but I'm not quite comfortable that we have the statistical significance figured out. But we run forecasts. So, and we do that by doing exactly what you're suggesting here. We basically back up 5 days. So we back up 5 days and we forecast 5 days ahead where the price is going to be. And we're like, I mean, with SPY, we're like 98% correlated. It's kind of crazy how well it works. Let's see if I've got that. So we'll take a look at it.
Yeah, I mean, it's at least on the S&P, on an ETF that's kind of smoothed out because of all the member stocks that are in that. At least it seems to work pretty well, at least on that 3-month, window.
Yeah. I think this will do it. Let me just do this really quickly. So if I use January 1st through today.
Yeah.
Year to date, let me just do a quick calculation with SPY as an example. So here's price versus forecast. 98% correlated. Wow. So what we're doing is that's market structure bands. We run market structure bands, and it has to we calculate. That is literally, we are calculating future prices. And what we have found is that wherever standard deviation widens, let's say now the graph is skewed, so it looks better than it really is. But could we say, okay, when standard deviation widens to the downside, is that a bottom? And when it widens to the upside, is that a top? It's basically what broad sentiment does. But there are periods where we were way off right there too. This is the election right there. So, we correctly pegged the bottom. We did not peg the top. There was a pretty big divergence, but you would know that standard deviation has widened.
Right.
Assuming we could get that perfected, we'd add it. I mean, we've got a list of things I'd like to add. It's just, I always have my reasons for why we have not done something. And we'll have a look at it, Barry. We'll take a look at that.
Like I said, I've been noticing it over last, say, 6 months or something. You start to see that more of a correlation if it's not laid out. So, but anyways, just thought I'd throw that out. So
I appreciate it. Keep throwing those things out.
Over
to you, Brian.
Perfect. Let me make sure I don't have a bunch of windows open, which I sometimes do. All right, we had a question from Dana in regards to more of the let's call it longer term positioning and how you can potentially do that with Edge, and you can really do that with any individual stock. I'll just look here at the broad market for a moment, and let's bring this back to a year-to-date look. Couple of things that you should know about the market. Of course, green is market structure sentiment. That's our demand algorithm. We don't move below the green line very often. Think of the green line as buying opportunities in the market, and it just does not happen very often. You can back this graph up further, and I'll say maybe 2 to 3 times a year. So, that's one way that you can think about things from a long-term perspective. If you're looking for buying opportunities, gets below the green line, get aggressive. That's the best way to phrase that. It just does not happen. And when it does happen, you might have a brief lull. We did back in COVID time and what have you. But ultimately, the market moves higher. When it gets above the red line, as Tim mentioned earlier, well, that's a period to get a little bit patient. I ran the exercise above the red line slightly different way than Tim did. What I've done over the last 5 years, I've measured these periods. So you see that period, red line to red line, red line to red line. Over the last 5 years, when the market is above the red line and retreats back below it, your gains are 50 basis points. And once again, that's a central tendency. You'll have times when the market can move up by 4 or 5%. You can have times where it moves down 4 or 5%. But over a 5-year period, the market gains tend to level off. You can see it right here. Market levels off. You can see it here. Market levels off. You can go back to almost any period. You can see it right through here. Market levels off. So that's a couple of ways that you can think about it from a broad market perspective. When to get aggressive and when to take some of that aggression off, I guess. If you're looking to short the market, it to be honest, it's challenging. We have a market that just by its very nature supports, let's call it inflationary measures. We have a limited amount of securities, and we have about the same number of ETFs. Guess what that does? Over time, that creates inflation for the market. Barry Norton works really well with this in terms of shorting. But I would say if you were looking to short the broad market, you don't have a very big window, but usually between about 4.5 down to about 3. But like I said, it's just a difficult trade. You can catch them from time to time, but they tend to be 1 to 2 day windows. Speaking about catching volatility, I'll switch topics here for just a moment. Tim talked about this earlier with UVXY. It's a fantastic trade. It's also a very fast trade. So look at the gains that you could have made back in August on this trade. And then a lot of times you'll see, 5 or 10% moves. You have a number of those 5 or 10% moves. But once it moves in that fashion, sell it because it's going to go back down. The market generally supports low volatility over time, and these windows are very, very fast when they do happen. Dana, hopefully that covers your question a little bit in terms of some of that long-term positioning. Feel free to reach out to any of us, via email if you have other questions on that. For a second here, I'll take this topic of low short volume, and Tim mentioned it briefly, and I'm going to take this graph back about 5 years. And to me, it's a real question of what is occurring right now from a short volume perspective. You can see right away that this is just an extreme outlier. There's no other way to phrase that. We saw short volumes move lower right ahead of earnings. It supported very nice advances in the broad market. I thought short volumes would start moving higher after that point, and you can see that they have not. You have to go really back to 2021, post-COVID recovery. Obviously, a very different environment at that time, and very low short volume environment across the market. Interest rates were near zero. Very bullish for the market. What is this communicating right now? I don't know, to be honest. Is it an outlier? Are market participants setting up for something different with this new administration in January? Not sure. Not sure. For now, it's just an extreme outlier. But from a big picture perspective, we are currently in a state of divergence. Normally, if we're not above the red line, which we are right now, normally if you were, say, like right through here, something like that, market sentiment moving higher, short volume moving lower, fantastic place to get into trades. It supports appreciation. You can see how that was playing out in the market. With the market above the red line right now, we could get a little bit of a lull here for a period of time. Consider options expirations, which is almost 2 weeks away. The market's very dependent on derivatives, especially with above the red line and kind of a lull in the market. We could get just a period of the market resting here for a period of time. Could we see advances through the end of December? With this setup right now, I would say probably so. Obviously, we could make that argument either way, and Tim did it, very well, that when short volume is low, at some point it does need to move higher. But are we establishing a new environment for short volumes right now? I don't know. We'll just have to watch the data to see how that plays out. I'll mention one other item here and then see if Tim or Henry have any other comments. The other item is just kind of from a big picture perspective. How should we prepare ourselves as we get closer to January trading? Look at what happened here during previous Januaries. So we look back to the end of December, right at the beginning of the year, the market just took a quick downturn. We get to the end of December 22. Well, we immediately go into a bullish market environment. We come to the end of December 23, just a very brief lull, and then it was once again off to the races. The point is that January can often be very predictive of the turn that the market might make for that given year. Of course, it's not always the case, but you can see it the last 3 years. Bearish environment, bullish environment, bullish environment. What comes next? I don't know, but low short volumes right now tells us that it's pretty bullish. Once again, with perhaps a lull here because of us being above 6. So with that, I'll stop for a second and see if there's any questions or if there's anything that Tim, you or Henry would like to add.
I could offer one observation, and it might compete slightly.
No, which is good.
I don't see. I'm guilty of confirmation bias because I have a trade. Anytime that you have a trade, you want the data to support the trade that you're engaged in, right? Mm-hmm. So we all do it. We're all guilty of confirmation bias. But what I would point out is this. I think that what we do know statistically, periods of very low volatility are always preceded by sharp volatility. Always happens. What you don't know is how long it takes. We have our theory for why that happens. Much of the market, in fact, the rules that the SEC has propagated regarding sub-penny spreads and how they're going to calculate those, and different definitions of round lots. So a round lot for stocks from $1 to $250 would be 100 shares, but from 250 to, I forget what it is, $1,000, 40 shares, $1,000 to $10,000, 10 shares, over 10,000, that was only one stock over 10,000, Berkshire Hathaway Class A shares, which we can't even run data on because it doesn't trade on the exchanges. It doesn't, it's crazy. The round lot would be one share. Okay, so the point I'm talking about is the rules are all designed to try to dampen volatility and get everything to trade the same way so people won't chase outliers, right? Because that's what machines do. Here's something I would point out. See this period? This is a very similar period, right there. That steep drop. What happened in the market? Tremendous volatility. Now, there are other factors that come into play. It's not the only thing. Monetary policy changes. You could look at any situation like that. Coming out of the pandemic, we went from very high short volume to very low. That was a very steep drop, maybe even steeper than now. What happened? Tremendous volatility. Here, very steep drop. This is, the end of this was coming out of this is a bear market, right? How do you know a bear market? Because there's a lot of white space in there. The demand cycle breaks down. Bull markets are typified by a lot of green. I see all the green between the red and the red line and green line. That's a bull market. When it breaks down, what does it look like? It looks like this. What does it look like here? It looks like that. Now, yes, the peaks are higher than they were here, but this is a break. Now, maybe the election changes it. I don't know. But I'm telling you that without that, this is a end of a bull market. Again, I don't know what's going to happen. But that to me says there's going to be a spate of volatility. What I don't know is it weeks or months. Right? Will it happen? Yes. Will it happen tomorrow? Who knows? I don't know. So it could be that, my volatility bet on that will be incorrect. But it is without question true that if things are abnormal, they will mean revert. If you have abnormally low short volume, that will change. If you have abnormally low volatility, it will change. If you have the market defying demand, that will change. I know all of those things will change. What I don't know is when. That's really helpful, isn't it? That's all I got.
I'll mention one other item in regards to volatility. The last 200 days, volatility has been 2.1% for the S&P 500. Right now, it's 1.9%. So to your point, Tim, it's on its way down. If it even moves a little bit below that, that's when you know that you're going to have some type of volatility event. You don't know how long it'll be, but yeah.
Yep. Well, I'm sorry we left no time for Henry, but we've consumed all our time, which means Henry gets a big
thoughts, guys. I just been holding on to him.